Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me today is my fellow co-host and CMT, David Blake. It's Monday, June 17th, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out going forward. We do it mostly from a technical perspective. David, I hope that you had a great weekend. How are you
Yes,
doing today?
thank you.
Good. Well, let's get started by taking a look at the market letter.
All right, well, we had another volatile week last week. We actually did see the NASDAQ and S&P 500 extend their win streaks and record several new highs, but it wasn't all easy going. Investors were kind of cautious to start the week out. They wanted to wait until we got some of the May inflation data, which came out on Wednesday with the CPI and Thursday with the PPI. And we finally saw a little tick after seeing those numbers kind of hold steady and maybe remain a little sticky for the last couple of months. We started to see them start to come down a little bit, and that helped bring rates down. We actually saw the yields on the 2-year and the 10-year have their biggest swing lower, probably in several months. I know the 10-year Treasury was down 21.6 basis points and ended the week up at 421. The 2-year landed at 468, and that was down 18.7 basis points. So that was something that was kept stocks rolling. We also had the FOMC meeting come out wrap up on Wednesday. We saw we heard Powell come in a little bit more hawkish than what the market wanted to hear. He didn't shut down a September rate hike, but he kind of led the market that he expects maybe one rate cut by year's end, and that kind of sent stocks lower despite big lower in yields. But then we kind of bounced back. Investors bought that dip. Then late afternoon, although the Dow Jones moved lower, the S&P 500 Nasdaq again made new highs on those days. Thursday, we got a bit of a rally, mainly on big cap tech shares again and semiconductors. Cyclical stocks, and by that I mean some of the financial and industrials type thing, they are not participating in this move higher, especially the financials and industrials right now. But we're being held up by big moves in semiconductors. We had Broadcom came out with their earnings last week, and they announced a 10-for-1 split. They're also announced that their AI business was really moving off the charts. So we get a lot of big moves in the hardware AI stocks, not so much on the software AI stocks, although they have had a decent year. But anyway, the Dow verged away from other indexes, which has been happening now for a second week. As far as the sectors go, and a broadening out of the rally, we're still not getting that. The tech sector, XLK, it was up 5.58% last week. That's a big move on these things. It recorded several new highs, and that was followed by gains in REITs and the consumer discretionary sector. But almost every other sector was lower, and that included energy, which was the worst sector last week, followed by financial and industrial. But I would say that would remind people that we did see crude oil prices, despite the big drop in the energy sector. They broke a losing streak that's been on there for 3 weeks, and actually today we're moving even higher. We're pushing 80 again a barrel, so that's something to kind of watch in there. We also had a good T-bill auctions last week, which helped after the cooler inflation data. That helped the 10-year rates come down a little bit. Actually got down as low as 421, I believe. And today we're up a little bit higher today. And part of the reason for that is had the Empire State Manufacturing Index came out this morning. It was -6, which it is still in contraction mode, but going out. In fact, we're looking for 30.1, so that was kind of a big miss. But then going out 6 months, they do see it hit its highest number in about 2 years. So the manufacturing does look like it's starting to feel maybe some orders could start to pick up here towards the latter half of the year, especially I think if rates come down. This week we have retail sales tomorrow. That should be a market mover. Again, we're you kind of want some Goldilocks numbers here. If they get too strong, then you're going to see probably rates tick up, and that could be bad for some of the cyclical areas. And then Thursday, we'll get the week's jobs data again. and we want to see how whether the economy is still on track for a soft landing. We have had the initial jobless claims tick up, I think, now for about 3 straight weeks. And it'd be good to keep seeing that because remember last week we finally got over 4% on the unemployment rate, and the market did like that. And that's something that the Fed has said they wanted to see a little bit softer jobs market before they think about moving rates higher. Okay, the technical condition of the market was mixed last week, and that was mainly because Dow Jones, like I said, veered off from the S&P and Nasdaq. It's called that negative divergence. You don't want to, you want to see all indexes kind of moving together. And then on the opposite side, you're starting to get this in the secondary indexes, the Dow Jones Transports and the small cap Russell 2000. They're also trading lower and they're breaking support levels. We got the Dow Jones below its 50 and 100-day moving average. And these are kind of key support areas that's starting to break down. And I mentioned in the letter that we're very, very close to triggering a bearish head and shoulders breakdown. That would, if that does happen, and that to happen, we need to see the index trade down below, say, 38,000, 3850. We do have support on the Dow at 37.6, which is the April low. That would, if we do get below 3,800, people are going to really watch that. And if that 37.6 doesn't hold, then that sets up a much lower price somewhere down around 37,000 for the Dow. Not sure that's going to happen, though, as we've mentioned several times, as long as you have these rate cuts still on the table, kind of keeps a floor under the market. Another kind of ominous sign is we saw the Dow Jones Transportation Index. It fell back to its lowest level on Friday. It looked like it fell all the way back to its November levels, but then all of a sudden they came in and bought that at the close. I mean, it was down, I don't know, something like 3.5%. It was really falling out of bed, broke down below the 200-day moving average. We had a death cross where the 50-day moving average crosses below the 200-day. But then, like I say, towards the end of the day, we saw a lot of buying going into the transports. And if you look on the chart, you have what's called bullish candlestick hammer. And that's where you have a long wick at the bottom of the candlestick. And then that's where it sold off. And then it came back up and we ended up with a small body on the candlestick. We could take a look at that later on if you'd like. And that's generally considered a bullish sign. It's kind of like a bottom is put in. And we're going to get a little bit of a follow through on that today. We're seeing the transport's up about 45 points, which is about 1/3%. So that's something to kind of watch to see if that hammer candlestick is a sign that the net transport's put in the bottom. That would be good. We also saw divergence again in the Russell 2000, and that's kind of a little bit surprising because as rates go down, small caps are usually one of the beneficiaries of lower rates because you have this, it's just cheaper to borrow money, and these small groups, these small companies, need to expand their business by borrowing money, and the higher rates are, they're not going to borrow as much. So as rates begin to come down, you're going to see the Russell 2000 probably start to move up. But right now it's going sideways to lower, and it also closed below its 50 and its 100-day moving average. So that's something that we want to see. If the small caps are going to continue to maybe go sideways, that would be something that we're going to look for. Now, underlying breadth, which we talk about every week, it did not confirm the record rally in the S&P 500 and Nasdaq. And what I mean by that, when you talk about a non-confirmed high, what you want to see is you want to see the NYSE especially, and then the Nasdaq. We at least look at their advanced decline lines, which we are consider leading indicators of market direction. We want to see those expanding and moving up at the same time that the market is. When those are showing negative divergence, and it means that most stocks are under distribution, and that means that the rally is not confirmed by volume or by the AD lines. And that's a negative sign because it means that you have a narrow group of stocks that are leading the market higher. And if you turn on the TV, you hear it and you see it every day. It's in NVIDIA now. We have Microsoft, the Broadcom, you have, Meta platforms, these stocks. They just keep on going. And then you're starting to, you look at stuff like Ford or just some of the cyclicals, they're going sideways to the lower. And that's just not a good sign. The problem is if you get a reaction from something in the big caps because they're so overweighted right now. If they start to tumble, they could just pull the rest of the market down through some of these key support numbers that we want to keep our eye on. So that's something that that you want to keep an eye on. I think the NYSE 8 line lost about 1,600 units last week, and the Nasdaq dropped about 2,700 units. So you're losing 2,700 units on the Nasdaq AD line while the index goes up 3.5%. That's something that's not a healthy sign. So we want to kind of watch that. The other thing that we're looking at is we see the new lows outnumber the new highs, especially on the Nasdaq. On the New York, you still have more new highs than new lows. I think last week we had 240 new highs on the NYSE to 158 new lows, but on the Nasdaq, you only had 315 new highs to 409 new lows. Again, that shows negative divergence in the rally as something that you don't want to see. Finally, one of the things that we looked at is I mentioned the Market Edge Industry Group. We have 91 industry groups that we follow, and normally as the market's ticking higher, you want to see expansion in these industry groups. 2 weeks ago, 3 weeks ago, the number of industry groups that were rated strong or improving was at 54, and we had 37 industry groups that were weak or deteriorating. Well, even though the market's up here setting new highs, that number has fallen back to only 29 industry groups are rated strong or improving, with now 62 groups that are rated weak or deteriorating. Again, it's another sign of negative divergence, which you have to at least consider that we're probably near a high. We had targets in my targets on the S&P 500 we had a couple of weeks ago was 54.20, 54.25. We're above that right now. We're at 54, 57. So we're about 25 points over. We had a target of 19,300 on the Nasdaq 100. It's up around 19,800. So it's above the targets. We get those targets off of our forward lines of demarcation, our FLDs. And the fact that the market has overshot those is actually a bullish sign going forward. But I do think that, as I mentioned, we are overbought in some of these indexes. Today, the Nasdaq's up another 95 points. I believe we're in the low to mid 70s on the 14-day RSIs on that index, the Nasdaq 100 index, and the S&P 500. So again, we're staying in overbought territory. If you wonder why the S&P Market Edge S&P short range oscillator isn't overbought, it's because that looks at the total market, and when that oscillator looks at the number of the AD lines and how the Dow and transports and the small caps are actually going lower, that means the total the broader market isn't overbought. That's all that divergence in there. So normally if you're making new highs, a lot of times you'll see that S&P 5, the SRO, getting up where it's around plus 7 or 8. Then everything's moving up, and it's probably time to things have heated up a little bit too much. But anyway, last thing I want to bring up real quickly is the sentiment index. We did see that tick higher again, and we were starting to see it move back towards a neutral reading, but we did see the number of bulls pick up a little bit more. We still have percentage of bullish advisors are still about more than 3-1 over the bears. That's kind of a negative. And we also saw last week, we saw the VIX traded as low as 1188 on Thursday when we were having a big rally. I did close the week at 1266. That kind of, when it's that low, that's also starting to get a little shaky. That means that you got to kind of watch it. That means the traders are very complacent about what's going on in the market. And when traders get too complacent, that means they're kind of ignoring some of the signs that are pointing to some divergences, that type of thing. So that means they could get scared a little bit because they're not expecting something somebody to pull the rug out from under them. So a lot of mixed signals in this market. Normally you'll see is something that you need to keep track of. Just because you're reading that the market's going up to new highs every day doesn't mean that, oh boy, everything's great. You can see with some of the stuff we just talked about, you have some bearish indicators going on underneath the the broader market that are telling you that everything's not all rosy. This is still a very narrow rally. In fact, it's narrowed even more than what it was earlier in the year, which we had a little bit of a news where economy looks strong, and we saw that little bit of a sell-off in, was it April? We almost had a little bit of a correction. We're ripe for something like that. And again, we've talked about our cycles. Sometime, will turn negative, which probably means that we're probably getting close to the highs for the summer. I think we probably have a little bit of juice left over here, and I would look for the market to probably kind of churn sideways, do some backing and filling over the next couple of weeks. And then at some point, I think that if the divergences don't clear themselves out, and again, the big risk on to this market is that also if we get one more bump up in nothing, everyone now thinks that inflation is going to come down. But if we happen to come out here 1st of July and all of a sudden we get a tick up in inflation, instead of it being 3.3% higher over the year, it goes to 3.5 or something like that, this market could get hit pretty bad, because that would mean that Fed would, perhaps somebody might start talking about, well, maybe we need one more rate hike going forward, which I don't think that's going to happen. But if it does, it certainly would throw the market for a loop going forward. And then, of course, I think you still have election problems that could cause the market churn sideways or to lower as the uncertainty of the election moves forward.
So you did mention that 2 weeks ago you targeted 54.20 to 54.25 for the S&P 500, and that we've hit that target. Do you think that that price target can go higher than that?
I'm not going to move it higher. And the reason because I go off of the FLDs that we look at, and that was where they are. But what like I mentioned, when the market exceeds the targets, that's normally a bullish signal, and that means that I think that we probably can. I think we'll probably hold in here. We'll have some up and down days, so I think we will have an upward bias for the next couple of weeks as we start to see things. As long as there remains a rate cut underneath the market, you're going to keep that upward bias. What's going to cause that to go away? I'm not sure, but that keeps. They call that the Fed put, and that's something that is very strong. The fact that no matter what's going on, even if things are slow, you're looking at, you still have that rate cut in your back pocket that is good for equities going forward. But it can always be some surprises, or maybe you get a big jump in also June comes out and you have a big jump in jobs, or like I say, all of a sudden things are looking good. You get some good industry manufacturing data, and all of a sudden you get a surprise uptick in inflation. That's not going to be good, because then your rate cuts pushed out till next year, and that wouldn't be good for the market. And actually, a week from this Thursday, you have debate that could move the market if both candidates come in there and just flop through the whole thing. You have a lot of questions coming into this election. I don't think people feel good about it, and that can be reflected in the market. But just to wrap it up, this week, tomorrow, let's look for the retail sales. I think if you exceed, or if you go over too much, or I think they're looking for up 0.3%, which is the same, I believe, as may have been. If it jumps up to where they're up like 0.6, or they go down to where they're flat or down, you could probably see rates move one way or the other off of that. If they come in line, then I think maybe the market kind of goes along. We can still have that upward bias and move sideways. And then we want to watch initial jobless claims. We've had 3 weeks in a row where we're up. Last week went up to 242. I think when we get over 250, people are going to start thinking, okay, now we're starting to see growth problems where you're getting a tighter job market, and that could kind of feed the talk of where rate cuts to be back on the table. And as I mentioned last week, despite Powell saying that he only expects one rate cut, the market doesn't see that. The CME Group, FedWatch, I think about 2 weeks ago, we were down to about 47% probability of a rate cut in September. Last week, that jumped up to about a 70% probability. So the market calling Powell out on this, and it's still pricing in 2 cuts. So we'll see how that plays out here over the next week or two.
All right, David. So we are actually running out of time for this week, but I just wanted to send a reminder that the stock market will be closed on Wednesday for Juneteenth. So we do have a short week this week. But if before I let you go, David, is there anything else that you would like to add?
No, I think we're good. Like I said, I think it's going to be kind of a quiet week this week with the midweek holiday, and we could get some movement again in the retail sales and initial jobless claims. But other than those two things, just I think we probably just go sideways with a little bit of upward bias. One other last thing, we do have 4 Fed members giving speeches on the economy tomorrow. There's always a chance that one of them comes up and pulls something out of left field and says something that could moves rates, but I don't expect that.
All right. Well, thank you again for all the helpful information, David. We do have to wrap up this week's Tech Talk Tuesday. We want to thank you to all of our listeners for tuning in, and we will catch you guys again next week.